Well, sentiment stayed relatively firm last week after solid tech earnings from Apple and Amazon, plus Fed Chair Powell effectively ruling out another rate cut, providing extra support to risk assets as well, allowing the S&P 500 to notch back-to-back weekly gains for the first time since March, while Treasuries rallied across the curve and the dollar rolled over, having its worst week in a couple of months. A much quieter docket awaits this week, lacking major data or earnings releases, with focus therefore falling on Thursday's Bank of England decision, plus three huge Treasury auctions out of the United States as well. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's crack on with the show. Of course, when I say without further ado, let's crack on, what I really mean is let's remove the opportunity for me to mess up the introduction for a fourth time. So let's bring in someone who is hopefully a little bit more competent than I am, my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good morning to you. I hope you had a brilliant bank holiday weekend despite the typical British weather yesterday.
Yeah, I'd like to say I did, but unfortunately I hit the golf course and I think I'm better off playing my feet than golf clubs. But yeah, and then the weather, obviously, and managed to spend loads of money on the kids buying carpet for their room. So, yeah, I'm struggling to work out what exactly went on this weekend, but I spent a lot of money and did enjoy it.
Well, I hope none of that money went on a ticket at the London Stadium at the weekend to watch West Ham, because that really would have been a waste, wouldn't it?
Oh, let me guess, you had a win for once. Oh, there we go.
I know, but, you know, Man United next weekend, I know they were a bit of a shambles last night, but maybe they'll turn up in a big game. I hope not, but, you know.
I hope they do. Hope they stuff
I'm sure you do. I'm sure you do. But there's plenty on a markets-related note that we should get on with rather than a football one. So let's crack on with Topical Fun. Right, very monetary policy, central bank heavy show this week, given all of the shenanigans that were going on last week and the three key decisions that we've got coming up this week. But we'll kick off with what happened with the FOMC last week, and pretty much exactly as we expected from Chair Powell and co last week. The Fed funds rate held steady at 5.25% to 5.5%. That was, of course, a unanimous vote, and we're now in the 10th month of rates remaining at that level. And interestingly, if you do the research, the median duration between the final hike and the first cut is actually 8 months. So we are somewhat over that now, and it doesn't seem like cuts are on the horizon anytime soon. The statement was pretty much a cut and paste from that delivered in March, with the Fed continuing to seek confidence that inflation is returning towards the 2% target before delivering that first cut. And obviously, the data that we've had to start the year hasn't given them the confidence that they're seeking. But while cuts may seem some way off, and we're looking probably at the early autumn for a rate cut to now happen, it's clear that the committee do want to deliver that cut as soon as possible. And it is also clear that there is not going to be another rate hike. So unfortunately, Dickie Matthews, I think, is still crying in the corner that his call is not going to pan out. And Chair Powell killed that one pretty explicitly, saying, and I quote here, "It is unlikely our next move will be a hike." Helpfully, the chair also outlined three scenarios as to where policy goes next, two of which lead us to a rate cut, either due to what the Fed are terming unexpected labour market weakness. The other path to a cut is on inflation coming back towards target. And the third path that Powell outlined is that rates simply stay where they are, and they're happy to hold rates where they are for as long as necessary if inflation remains stubbornly high to bring prices back to their target level. So no baseline scenario, at least, where another hike is on the cards. Of course, that needs to be coupled, that relatively dovish outlook needs to be coupled with the quicker than expected taper to quantitative tightening. The Fed were, or are, I should say, up until the end of this month, letting $60 billion worth of treasuries roll off their balance sheet on a monthly basis. From the start of June, that's going to be cut to $25 billion. So helping liquidity conditions somewhat and also reducing the chances of potential funding issues popping up. But I think that does probably mean that you're going to end up with a smaller Fed balance sheet overall. A slower pace of runoff probably means that they can embark on quantitative tightening for longer, which means that the balance sheet may be smaller overall. So that is perhaps net no effect on risk assets. But all in all, the Fed are remaining pretty supportive. The Fed put is clearly still here, I think, as a result of that, and we'll get onto this later on. Risk should continue to move higher. And I think the market, and I'm keen to get your thoughts on this, Ryan, is much more fairly priced, because we were talking this time last week about the curve pricing, 30 basis points, even less than 30 basis points at one point of cuts by the end of the year. The market's now back at 48 basis points of cuts by the end of 2024, which to me seems a little bit more in line with what the Fed are likely to deliver based on what they had to say last week.
Yeah, a bit of a strange one last week, because the market again went in a little bit hawkish, wanting Powell to say something towards hikes. And he was very, very reluctant to go down that road in any way, shape or form. He was pushed several times on that matter. But still, I think that the market isn't going to give this up, because, as I said last week, we keep seeing the Fed saying the same thing, but we keep seeing the data saying another thing. And that hasn't changed. But, the pendulum swung once again after we got the NFP data and the ISM data. And, it was as if that NFP report was a bad one, which it wasn't. But the market obviously got back to, yes, they're going to cut. But then how long is that going to last? If CPI comes in a week or so's time and that's hot again or very sticky, we're going to play this game again where the market gets all hawkish. So it's this constant to and fro between what the Fed keeps saying and what the data keeps saying. And until that gets resolved one way or another, it's going to keep the pressure on. As much as they're reluctant to get into a hiking scenario again or rhetoric, how long do they want to keep rates this high for before it really starts damaging the economy? And, as much as they want to cut, and they do, they're going to be pushed to the limit if they're keeping rates higher for longer.
No, I think you're right. And I'm glad you bring up that point around, volatility, because the Fed are data dependent. They've been very clear that their reaction function is dependent on the data that they receive. And I think it's also worth noting, we heard from New York Fed President John Williams late yesterday, Monday afternoon, and he was saying that he expects data to become increasingly volatile in the quarters ahead. So you would therefore naturally expect the market reaction to that data to perhaps also remain as significant as it is at the moment, or even become more so, particularly on the inflation front. But just one last point on the Fed. I do actually think Chair Powell played a blinder in the post-meeting press conference. By my maths, and yes, I'm sad enough to have gone through the transcript, he was asked 5 times about whether they will hike again, whether another rate increase is on the cards. Powell himself only used the word hike once, and that was to say the quote that I said earlier: it is unlikely the next move will be a hike. Every other time he straight batted that question away, which, when you look at the media shambles that we've got with some of the other central banks, particularly down on Threadneedle Street over there, I think Chair Powell could go and teach them a lesson or two. But speaking of those other central banks, we've got plenty others to get into this week as well, haven't we?
Yeah, very much so. We got 3 other central banks to be aware of. We've already had the RBA out this morning. They left rates unchanged as expected, and they weren't as hawkish in the statement as some banks had expected. A couple of banks thought that they might put in a couple of hawkish lines in there about hikes, but they didn't. And although Bullock has left the door open to further hikes, as she said this morning, if upside risks emerge to inflation or it takes longer to fall. So they have another bank reluctant to be too hawkish, but not firmly shutting the door on hikes just yet. The Riksbank is out tomorrow, Wednesday, and they're expected to cut by 25 pips, start their first cut cycle, their first cut after all, keeping rates where they had been at 4%. This cut is coming after inflation came lower than expected, and they have been touting this cut for quite some time now. And prior to that, they did say that some central banks pose a risk to this cut this month, which we can assume the Fed is front and centre of those thoughts. But as they weren't hawkish in the slightest, the Fed, the Swedish central bank looks to have the green light to go ahead with their cut this week. And as with most central banks, just started out on their sort of mini cut cycle. The forward guidance on future cuts will likely be more important than the expected decision we get. Sweden has a fairly lowish interest rate at the moment, 4%, going to 3.75. So they won't be travelling too far with cuts to, whatever I presume neutral level is, might be in the 2 to 2.5%, 3% range, something like that, obviously, depending on the data. And lastly, we have over in Mexico, Banxico, who started cutting at their last meeting in March, expected to stay unchanged this month. The vote last time was 4-1 to cut, and that's the first place to look to see if there's any division on the board. Again, with the US staying on hold, that will be a big consideration to the bank and to carry traders who will want to know if the profitable rate gap is going to narrow significantly. Like the Riksbank, the future guidance will probably be the more important aspect of this one. So if you're trading currencies for any of these central banks, remember just to look at their various crosses for the divergence trades as opposed to matching everything off against the dollar, because we know what the Fed are doing. They're going to be the bigger swinger, but there may be more value in some of those crosses.
Yes, indeed. I think you're absolutely right. I see we're going all EM now. Are we bringing Mexico into it? I mean, I think there's a couple of other LATAM central bank decisions this week. Brazil maybe on the cards as well. I'll admit it's not one that I follow particularly closely, but it's definitely worth keeping on the cards, because I think actually it's worth noting that a lot of these EM central banks hiked a lot quicker and a lot more aggressively than the developed market central banks, because they can, and they are also cutting a lot quicker and a lot more aggressively than the DM central banks as well. So worth bearing that one in mind. I think you've covered all of that pretty comprehensively, to be honest with you. The RBA very much following the line from the Fed, really. I think higher for longer. They actually extended the duration that that the cash rate, will be on hold in their forecast by another 9 months compared to their last forecast round. So higher for longer. They don't want to hike again. I think the market's pricing about a 50-50 chance that they hike by September. That seems massively overdone. And then on the flip side of that, when I checked yesterday, and appreciate this may have changed, but a Riksbank cut was only priced at 55-60-ish% when I checked yesterday afternoon. And again, that seems a little bit underdone, particularly with the Fed in a relatively dovish stance compared to where they could have been, and also the ECB set to cut rates in almost exactly a month's time from today. So I don't think there's anything to deter the Riksbank from cutting. But as you said, the key really is on the guidance in terms of what comes next, and whether we do get these big policy divergences, which at one point this year it looked like we would get them, but actually now it's looking like these policy divergences could be a lot thinner on the ground than we had expected.
Yeah, and I wouldn't pay too much attention to RBA forecasts, because if you look at back of their forecasts 18 months ago, a bit longer, they weren't going to start hiking until 2024. So that was those forecasts went well out the window back then. So, take those forecasts with a pinch of salt. They're nearly as bad as our lot over here, which you're going to talk about in a moment.
Well, indeed they are. But also, I'm not sure what calls I was making in 2021, so I don't want to go down that road too far. And we'll go back to safety, and we'll go back to the safety of Threadneedle Street with the Bank of England, because our old friends at the BoE announced policy on Thursday. And it's a super Thursday here in the UK, to coin the horrible financial media jargon that they like to use, because we not only get the Bank of England's rate decision and the policy statement, but we also get the latest monetary policy report. Sorry, I was going to call it an inflation report then. It hasn't been called that for some time. What are we expecting from the BoE this week? Well, bank rate is almost certain to remain unchanged at 5.25%. But as always, attention is going to centre on the vote split. Last time around, the 9-member MPC was split 8-1 in favour of leaving rates on hold, with just external member Dingra in favour of an immediate 25 basis point cut. I reckon it's going to be 8-1 once again. I know plenty on the sell side, and I put out a list of who is calling for this on Twitter yesterday, are calling for a 7-2 vote, because we heard from Deputy Governor Dave Ramsden recently talking about how the UK is now actually leading in terms of disinflation compared to peers, and that he views risks to the inflation outlook as tilted to the downside, which, and I know you want to cover this in a second, Ryan, but on face value, you would say that that's a pretty dovish speech that leans towards a cut. But you've got to remember that the internal members, the core of the MPC, typically vote as a pack. So I'm not sure Ramsden will want to leave that pack and go out on his own, although he does have some sort of wild streak inside him, which could mean that is on the cards. What else are we expecting from the BoE? Well, the statement should remain relatively unchanged, repeating the need for policy to remain sufficiently restrictive for sufficiently long to bring inflation back to target. But again, the minutes to the MPC meeting, which are also released on Thursday should repeat that the policymakers will view policy will remain restrictive even if bank rate begins to be cut, which means that they can keep using that line. They could make a dovish tweak to the statement if they wanted to sort of copy what the ECB have done and almost pre-commit to a rate cut at the next meeting by saying something along the lines of it may be appropriate to remove some or a degree of restrictiveness in the near future. That again isn't the base case, but it would be a pretty dovish move if they did lean into the idea of a June rate cut. And I think the latest economic forecasts are going to lean against market pricing, which sees just under 50 basis points worth of cuts priced this year. I think you're going to see both the inflation forecast conditioned on a constant rate path and also on the market-based rate path, both show inflation some way below 2% over the medium term, which is the Bank of England's rather implicit and frankly quite odd way of suggesting that the market is priced too hawkishly in terms of the likely policy outlook. So you've got to remember, we do have a lot of data between now and the June MPC meeting. We've got another 2 inflation figures and another 2 labour market figures. One, if not both of those CPI prints should show inflation back at 2% by the time of the June policy meeting. So I'm still of the view that the BoE are going to deliver that first cut in June and then probably cut quarterly after that. But Ryan, I feel you may have a different opinion on that.
Yeah, you know me, things are always more sticky for the UK and Bank of England than they like to say. I'm in the 7-2 camp as well. I think it's finally balanced between 8-1, 7-2. I think that for Haskell to turn over to the cut side just sends that additional message. You know, it's not a big thing. 7-2 is still a wide split, but it just shows that they're on the way. It's given a message without actually really giving a message, if you get my drift. But I think it was Haskell that was it him who said that the next inflation report is going to be at 2%, not or close to 2%, not closer to, close to 2%. So that would suggest that they're putting a lot of eggs in one basket over inflation coming down. Obviously, we've got to see the numbers after we had the energy price cap cut that came in April. That's, I think, is what they're banking on. They're going to talk about service inflation, which has been the sticky part of things. Wages, they've started creeping down, but not coming down with any great speed. The PMIs, literally every PMI you read, whether it's UK, Europe, US, still has heavy price inputs coming in. And I struggle to see how they're going to get the inflation move, or if they do get it, how long it lasts for before it starts creeping up again. So I think maybe they're painting themselves into a bit of a corner. We know they're one of the most dovish central banks around, Bailey particularly. So they're going to be pushing that way. And I don't think they're going to get the data going their way. Or if they do, it's going to come quickly and then it's going to bounce quickly like inflation. And I think that might catch them out. So no, I don't think they cut in June. But when they cut after that, maybe August will be the time they look to cut. But you never know with these clowns. They could cut tomorrow if they decided to wake up on the wrong side of bed.
Yeah, they probably could. They probably would, actually, to be fair to them. Maybe August. So you think we will move on in a second, but you think they may even hold bank rates steady beyond August?
Yeah, it's possible. If inflation doesn't come down, if we start seeing it pausing like we're doing in the US, then yeah, they're going to keep those rates higher. But I think, as I've said before with other inflation countries, I think 3% is really a yardstick. If we're well below 3% on inflation, then that puts it in the ballpark for them to cut. But you need to see everything down there. You know, the core under 3%, wages coming down as well, the headline under 3%. And, unless we really get all those numbers there, I think that keeps the caution within them. But as I say, that's my thought. The Bank of England and what they think on the MPC is completely different altogether. They probably see an inflation print of 2.8% or 2.9%, and they'll cut 50 basis points or something stupid like that. But, there's my thinking and there's their thinking, and they're the ones who got their fingers on the triggers. So that's
well, you're being quite kind, assuming that the MPC are actually thinking. To be honest, that's the first step. Hold that thought though on 3% inflation, because we're going to come on to that in about 10 minutes' time. But meanwhile, let's have a talk about sentiment first.
Yeah, trading sentiment, and last week was really a perfect example how traders get caught up in the razzmatazz of these big events. For the Fed, we had short-term market players, as I said, getting a bit too hawkish going into the FOMC, and that we saw the dollar getting sold off afterwards. And then for the NFP, the market had a massive reaction, in my opinion, to what was still pretty solid data with just slight misses of expectations. And if you had listened to some of the market at that time, you would have thought the US jobs market was collapsing and disappearing into a fiery hole. In those situations, you always need to know the bigger picture, because if you get caught up in that sentiment noise, data point to data point, that can sometimes lead to bad trades where you get in on one data point, try and run it into another, and it completely reverses. So this is a must for all types of traders, whether you employ short-term or longer-term strategies. Before you dive into a trade on a data point, or listen to some squawker on the news or wherever, understand what any data means. Yeah, well, no, you should be. Come on now, you should be listening to this show, because we do tend to have our finger on the pulse.
I meant the Aussie one.
Oh, the Aussie one. Oh, we'll forget those guys. But yeah, whatever you listen to, understand what that piece of data means for the bigger picture before it comes out. So in the case of Friday, I bought the dollar dip because I judged there was a massive overreaction to the data versus where the trend fundamentals are. That was just an instant smash and grab trade, not an attempt to fight tooth and nail against the market for the next weeks ahead. And take Friday's NFP again, the data will decide whether that jobs report will lead to something more or not. So until we see that, don't believe the hype and trade each data point against what the fundamentals to be.
No, I think you're absolutely right. And I think it's a very, very important point. And I think, most people will probably be aware by this point, I like to take a much more sort of medium term view of things. And actually, when we're talking about, the market, monetary policy is data dependent at this moment in time. What we mean by data dependency is not where the next data point is, it's where the trend in the data is. I think that the payrolls report is a prime example of that, because headline non-farm payrolls came in at 175,000 in April. I think it was the first downside surprise compared to consensus that we've had since November, December last year. So something like that. We've had a relatively strong run of beats. Unemployment ticked higher. And as you rightly say, all of the usual suspects came out with, ringing their bell, the end is nigh, all the rest of it. Absolute nonsense. Look at the trend in the data. Look at, for example, the 3-month average of job gains, 240,000. The 6-month average of job gains, 245,000. Both of those are pretty solid. Both of those are just above what we would call the break-even payrolls rate, which is the rate of job gains needed to keep up with the rate of growth in the labour force. And even unemployment ticking higher to 3.9 from 3.8%. We heard from Fed Chair Powell on Wednesday. He said very explicitly, unexpected labour market weakness is not a couple of tenths worth of a rise in the headline unemployment rate. So I think this is a classic case of, and we say this all the time, zoom out. Zoom out from your price charts. Don't look at a 5-minute chart. Look at a daily chart. Zoom out from the one data point. Look at the last 3 months, the last 6 months, the last 12 months. Look at where the trend is going, because that is going to determine where policy goes, and that is going to determine not where the knee-jerk market move goes, but where the prolonged trend in the market goes. And ultimately, as you love to say, Ryan, the trend is your friend in this game.
Yeah, very much so. And you're right. Powell, he did make it explicit. He says you're going to need to see a meaningful trend in jobs coming down before they look to cut. So it's not going to be one miss. But trends start somewhere, and I don't think this was it. But inflation ticked up, wages came down a bit. If we get another report next month, well, then maybe we've got something to get our teeth stuck into. But, there's times you can't fight the market because it wants to do what it wants to do. So, if you're going to fight the market, then just be careful and know that it's got bigger pockets than you do. But there's other times when you just look at it and think, no, you've gone too far just for this moment in time. So I'm gonna fight against you. And that's the way you got to trade in between these data points. And but keep your finger on that wider picture, on that pulse to see where the trends are going to develop.
Exactly that. Very well put. Right, let's get into some charts. Right, well, that was quite a good segue, actually, because we were just talking about trends, and I want to talk about one that might have run out of steam, and that is looking at the dollar. Now, most people will be aware that I've been bullish on the greenback for, well, pretty much all of this year, and it has served me relatively well. But I think now is probably the time to turn a little bit more neutral on the dollar over the next few months. There have been two parts to the bullish dollar story, in my view, and they've been either side of the dollar smile. You've got that idea of US exceptionalism and US economic outperformance, and you've also had some haven demand in the mix, as well as the situation in the Middle East has continued to play out. But it would appear, at least in the market's view, that both of those themes are slipping away a little bit and may have run their course. If we look at incoming US data, it appears to be, to coin a phrase, catching down to that of its peers, particularly if you look at some of the survey measures and the PMIs that Ryan alluded to earlier, and also how the market has adjusted its expectations for that data. The differential between Citi's economic surprise index for the US and for other developed market economies has pretty much gone back to flat, implying that now they are performing compared to expectations, bang in line with each other. And also, just an extension of that, it's tough to see the market pricing in a much more hawkish Fed outlook than it had when the dollar index was up at those 106.5 highs, when we had about 20 basis points worth of cuts priced into the curve. You also have haven demand dissipating as the situation in the Middle East appears relatively calm from a market and a macro perspective, not obviously from the tragic human side of things, which sadly we see continuing on the news on an almost daily basis. But in terms of a market story, that one does appear for now to have run its course. So I think, in my view, a resumption of this broad bullish dollar trend that we saw over the first, 4 or 5 months of the year needs the Fed to explicitly throw the idea of a rate hike back on the table, which, as we saw from Chair Powell on Wednesday, is pretty damn unlikely at this moment in time. But on the other side of that coin, broad-based dollar weakness needs you to want to buy something else in the G10 universe, which at the moment, nothing really looks particularly appealing to me. So I think we're going to remain in a bit of a range for the dollar for the time being, probably between around 104.5 or the 104 figure to the downside and the 106.5 previous highs to the upside. And I think the FX market, with policy divergence ebbing away, US exceptionalism ebbing away, the FX market might just plod along, treading water for a little bit, waiting within this range for another theme to emerge.
No, I think you're absolutely right with that. I think another scenario for dollar strength is, as we've been saying, maybe some stronger data, or data keeping as it has been. There's been a couple of wobbles in the PMIs, as we've seen, and some of those consumer sentiment surveys as well. But it's going to take a lot to break this one way or another. It's either going to be real confirmation that we're going to get a cut with some sort of timeline on it directed by the Fed, or else we are just going to waffle around. And you say that range has been pretty solid, and I think we're going to stay within that, and we're probably going to see other FX pairs doing the same thing as well. We had this moment where everyone was hiking at the same time, and now we're getting into the cut side of things. There's all people just moving at different speeds. Obviously, we got the BOJ who are just starting their hike cycle, whatever that may turn out to be. So the dollar index is fine to watch for your general overview of the dollar, but we do have other dollar pairs moving in different rates and speeds versus one another. So I think ranging for now, and but look for the catalyst that's going to cause a break.
Yes, indeed. Right, moving on to, I think, last week's most successful trader worldwide, the Japanese Vice Minister of Finance, Mr. Kanda, who played an absolute blinder with the yen. Yeah,
absolutely. He sold at 159.60 on Monday, and bought them back at 152 on Friday. We'd all love a trade like that with that amount of beans behind it. But he had a great trade. He should probably do a signal service.
But get him on the show.
Get him on instead of me. And
same haircut.
Probably, exactly. But the guessing games, continue with intervention, and after I warned that they don't watch data points, the MOF and BOJ, it seems they decided to intervene for a second time after the FOMC. Now, as much as that made me look a bit silly, I still don't think they're actually looking to actively trade data points and things like that, but more so to keep the market on its toes and not letting it get complacent with the status quo. The intervention last Monday, it ticked both the speculative and volatility boxes, but the intervention after the FOMC didn't really have either of those two factors. So it looks, as I say, they might be trying to change things up. Everyone sort of has this blueprint for the conditions for them to intervene. So why not just make it a little bit different to keep everyone on their toes? So for dollar yen, the big downside levels were 155 and 152. We smashed through the 155 level last week. And despite a brief 14 pip push under 152, we've bounced back well into 152 today. 155 will likely be the key resistance level here, if not just for buyers' nerves, but also while 152 is looking the support level. You've got to remember that people are going to get a bit nervous the higher this creeps back up, as the intervention threat has not gone away. But we have to remember that 152 support level, the MOF don't do text. They don't look at coloured lines on their chart. So if they want to hit it again, we'll likely go through it, and it will be like a hot knife through butter. Below 152, there's old traffic around the 150, 80, 151 zone, and then the 50 fib down to the 150 figure. So from here, I think we remain in a situation where rallies get sold quickly when the need arises, and those buyers will be quick to get out of any longs at the first sign of trouble. High volatility is going to continue in all yen pairs. It remains elevated. So for me, if I'm going to look to trade it again, I'll be looking more to trade this from the short side than the long side.
Yes, an interesting week last week for the yen, to say the least. That might be understatement of the year. I think there's probably three things I would mention on this one. One is, as you say, they may have changed the kind of conditions around when they step in, but the size of both the intervention and the subsequent market move is roughly akin to what we've seen in the past, kind of 3 to 5 big figures worth of downside in dollar yen, which is roughly what we saw back in September and October 2022 when the Ministry of Finance were last fishing around. The second thing I would say, and this is a point that I think you touched on last week, Ryan, is they're not trying to move dollar yen to a specific level. Kanda is not sat there at his Bloomberg going, we want dollar yen to trade 150. In fact, he hasn't actually been logged into his Bloomberg for much of the last week, which makes the move even more impressive. Instead, what the Ministry of Finance are trying to do is almost remind market participants not to excessively speculate in the yen. And when they do see what they deem as excessive speculation, they will stamp down on things, and they will do so aggressively. So it's not about preventing yen weakness entirely. If we trade from here back up to 160 over the next 2.5 months, I don't think there's going to be a particular problem with that. If the BOJ is still on hold, if Treasury yields resume rising, et cetera, et cetera, et cetera. It's when the moves become more speculatory in nature, that's when the Ministry of Finance start to get a little bit restless. And the third thing I would say is it just proves, I would argue, their intent to stamp down on things. That if you think about when they intervened very early last Monday morning on a Japanese public holiday, and then they intervened around about 9:30 at night, London time, 4:30, 5 o'clock in New York, when pretty much everyone would have watched the end of Fed Chair Powell's press conference and gone, right, I'm headed towards the exit door. So liquidity was pretty thin, volumes were pretty light at both times they stepped in. So effectively getting more bang for their buck, or bang for their yen, I suppose, when they were intervening in the market, which again just is perhaps a little bit of a signal of intent from the Japanese authorities as well.
Yeah, very much so, because obviously the dollar had been losing a bit of ground after the FOMC, so it was going their way, and they still decided to knock it on the head. So yeah, as I say, just that was just a slight difference to the norm, that they just want to spice things up a bit and keep people on their toes.
Indeed, yes. Although I think we'd all appreciate if they just didn't spice things up for a week, because we could just do with a bit of a rest. Right, moving on. Treasuries. I mentioned this trade a while back, and we also mentioned 3% inflation earlier on, and you'll now see why that's important. Because I want to revisit this idea of central banks, and particularly the FOMC, moving towards a sort of implicit target range for inflation rather than an explicit outright 2% target. Because I think last week week's FOMC meeting really reinforces that idea. The Fed again saying that they're happy, and in fact that they want to cut before inflation gets back to 2%. Not only do you have the guidance saying towards 2% rather than at 2%, you also had Chair Powell saying that, if the labour market unexpectedly weakens or weakens dramatically, then that is a condition for cuts to come onto the table, no matter what inflation is doing. So you see that dual mandate coming back into action. So I think what the implicit endorsement was, once again, is that we're now looking at a range. We're looking at 2 to 3% as the inflation target, rather than CPI or PCE or core PCE or whatever measure you want to pick, getting back to 2.00% precisely. And as a result of that, I think you're probably going to see two things in the bond market. You're going to see the front end continuing to rally as near-term policy expectations become a little bit more dovish. And I'm not, of course, just talking this year, but also the cuts priced or not priced for next year as well as that. Well, you should also see the long end move higher on a yield basis and sell off as you have inflation expectations moving higher, and also as the neutral rate begins to move higher as well. And all told, that should result in the curve continuing to steepen. We've seen that happen modestly over the last 6 weeks or so. I would expect that may now pick up a little bit of pace. So as a result of that, I'd be looking to be long the front end, short the long end, and play the trade as that curve steepens. You can do it in 2s, 10s, you can do it in 5s, 30s, you can do it in whatever you want. But I think that move towards a more flexible and fuzzy inflation target should see some selling pressure continue at the long end of the curve.
Yeah, as long as it does move towards target, and as we've been saying, and I don't think our mate Dickie, I don't think he should fold up his call for higher rates. I still think it's a possibility, more greater possibility than the Fed think, most definitely. But it's going to be tough at the moment. I spoke about 2-year yields last week. It could be a decider for the dollar, and indeed it was. As we went into the Fed, it was trucking up above 5%. After the Fed, we'd got all the way down to the 4.8s and even further. So it really got a knock on the head, and that saw the dollar coming down again. And it's important to watch the curve, to note what the market expectations are for rates, because it is a good indicator, even day to day, what the market's thinking about rates, and therefore what it's thinking about the Fed. So, and this inflation number, 3% is still my sort of pivot, my central bank pivot point for interest rates. Take CPI in the US, sticky for 10 months, above 3%. So until that starts moving, it's going to stop the market from doing too much, I think. But if it does start getting down there, then we need a date on when these cuts are going to come, and then the market can finally settle down with its pricing. But when you got folks like Citi still calling for 100 pips of cuts this year from the Fed, you got to think that some out there are still being a bit too dovish.
I'd rather believe Citi than Dick Matthews on their Fed call. I'll put it that way. Before I get in trouble with either.
Oh, you are in trouble. I'm distancing myself from that comment, Dickie. I'm distancing myself.
Right, let's move on to WTI.
Yeah, I'm going to look at oil. And is this the end of the rally, or just a pause before we make further highs? We saw a fairly decent sell-off last week, which sort of added to the moves that we saw, starting the beginning of April. This newest drop, though, took out some key levels at 82.50 and 80.50 before running into a brick wall at 100 DMA down at 78.20. That's just ahead of the 50 fib of this whole rally at 77.82. And that dissipation of immediate hostilities in the Middle East looks to be one of the main drivers for this move down, even as rumours of production cuts or extension to production cuts haven't helped keep the price up either. This technical picture looks very constructive for a bit of a bounce as these support levels look good. And this dip might just be a sort of trend refresh in the wider picture. However, if we do break down below this support, things might look a bit more grim. I'm still very uncertain about the demand dynamics for oil markets right now. We've seen some tepid rises in things like the manufacturing PMIs, but a lot of those rises are still in countries that are still in contraction. So things are just less rubbish than they were rather than really improving. The US ISM going the same way too last week. So there's still reasons to feel a bit more bearish or continue to feel bearish on the fundamental side of things. We also know we need to still be cautious as one bad risk headline and we'll be shooting up again. But I'm favouring the long side down at these levels at the moment, but I won't give it too much room in case we do break down again.
Yes, indeed. We seem to have a poltergeist in this office playing with my lights this morning. We've had all sorts in here. We have fire alarms, power cuts, doors being...
That's Dickie. That's Dickie. He's getting you. There we go. See, I said his name and it went. So he's got the hooju's over you, yeah.
I will fix that light momentarily. But what I did want to say just on crude very quickly is we had reports yesterday that OPEC are likely to extend their production cuts for another 3 months or so. The market perhaps not as tight as the OPEC Plus cartel had anticipated. And again, that should help support your bullish case. But while I go and sort out the dodgy lighting in this studio, why don't we roll the titles for our plays of the day? Right, now I'm back in the light. Let's get on with our plays of the day. I want to talk about the equity market this week when I've got my notes in front of me. There we go. I'll keep things relatively short and sweet, but staying long and strong on Wall Street at the moment. Both the S&P and the Nasdaq 100 front-month futures rallying back above their 50-day moving averages yesterday for the first time since the middle of March. It looks like buying the dip has worked again with a nice bounce off that 100-day moving average, particularly in the S&P 500. The bull case, frankly, remains intact. Earnings growth is still pretty strong. The Fed are providing some nice support as well, giving people confidence to continue moving out the risk curve. And it's a quiet week this week. We really haven't got anything of note on the data or the earnings slate, with really the next key risk events for financial markets coming on the 15th of May with the next US CPI numbers. And then, of course, the big Nvidia earnings report on the 22nd of May. So the path of least resistance should lead us higher into that CPI number. And of course, those breaks of those moving averages might bring some trend followers back into the market from the long side as well to help things along a little bit further. Ryan, we are back in Scandinavia by the looks of things.
We certainly are. And I thought about tying this one up with the Riksbank meeting, as it's pretty much baked in that they will cut. The Swedish krona will likely only move on any additional forward guidance. So if they do sound more dovish than the market expects, and we see the krona weakening, I'm going to look for a bit of a counter trade versus US dollar. And the reason why I'm picking this pair is that it looks like the market is back in whack-a-mole mode with the dollar. So any rally is likely to be hit on the dollar side. Therefore, if they are a bit dovish at the Riksbank and this sends this pair higher with the Swedish krona weakening, it might also get the mallet treatment. So I'm looking at a rally up to the 1103, 1110 area, that trend line up there with a stop just through that trend line. Or if it's big news, if they are significantly dovish, I'd look up towards that double top at 1124 again, with a fairly tight stop in case it breaks. So bit of a smash and grab if we get a dovish Riksbank.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as he always does. Hopefully you've enjoyed the show. If you have, drop a like on the video. Leave a comment as well. Let us know how you're trading the markets. If there's anything you want us to cover, or if you know a handyman, an electrician, a fireman who can come and fix the various issues that have taken place in this building this morning. Hopefully things are only going to head higher from here. In any case, wish you a very, very good week ahead. It's a little bit of a quieter week in the markets, but nonetheless, I'm sure Ryan and I will have plenty to talk about this time next week, which is when we'll be back with another episode of The Trade-Off, and we hope we will see you again then. In the meantime, thanks as always for watching. Goodbye.